You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors.
All right, everybody. That music means we are back once again. I am back from my travels to the South for the Futures Industry Association conference down there. Fun event. All of you on the pro side should have already heard the chat I had with the folks over there at SIBO about all the things top of mind for you folks out there right now. 0 day. When are we going to see more of it? What's going on with these options on these Bitcoin ETFs? 1 day VIX, will we ever trade it? All that fun and a whole bunch more. That's on the pro side now. Should be hitting the regular on-demand network sometime in the next couple of weeks, so keep an ear out for that. Probably next week is what I'm hearing behind the scenes. But I'm getting ahead of myself. My name, of course, Mark Longo from the THE, optionsinsider.com, as well as from the network upon which so many of you are binging. Hope you're having a good Fed week out there. Yes, it is indeed Fed week. The number always hitting during boot camp here, so hope your trades are working out here. Seems like the market is liking what they're hearing from the Fed right now. Everything in the green once again. So Powell keeping the rally alive. Of course, for all of you listening months and indeed years down the road, this will be old news to you, so we won't belabor the point. Of course, if you like what you hear, this, anything else we do, throw a like, a star, a comment. It does help new people continue to discover the content. If you want to join the aforementioned pro, you want to join us immediately after this show for something we've never done before on the pro. We've always had pro Q&A sessions. We bring on one guest, let them take on all comers for your questions. This time, you folks asked for a debate, a contentious one. So we're going to bring on not just one, but two guests in the pro Q&A hot seat. We're going to bring Carly Garner, one of our regular guests on TWIFO, to talk all about futures options, all that kind of fun in futures, as well as, of course, our buddy Mr. Russell Rhodes, a.k.a. Dr. VIX. They requested it. They want to go ahead on head-to-head. You folks in the pro requested. So that'll be coming up after boot camp today. Of course, if you're listening to this down the road, you already missed it. But then again, it will be there for you on the pro Q&A exclusive pro members feed. So get on over there, theoptionsinsider.com/pro. You could check out, of course, all the fun we have going on out there today, as well as everything else. 300 plus episodes waiting for you on that exclusive pro feed the second you hit that button, including that awesome debate. I got a feeling we'll be doing more of these because they're kind of fun. And if you're listening in the pro, you haven't gotten your questions in yet, what are you waiting for? It's going to be a fun one. Get them in now via the members hotline. As we go around the horn, see who's joining me on this fine Fed Day / Education Wednesday. I am pleased to be joined once again by our old buddy, the blackest of hats, Mr. Dan Passarelli from Market Taker Mentoring. Mr. P, welcome back to the show. How goes your Fed Day, sir?
Oh, it's going pretty darn good today, Mark. Pretty darn good.
You sling in any hot options trades ahead of the Fed?
What did I do? No, just updating the old IRA with some options trades. That's it.
That still counts. I'll allow it.
Yeah. Doing some covered calls, some cash secured puts.
All sorts of fun. I was working a fun UVIC strangle ahead of the Fed just for fun. A little bit of fun fodder. I just took off the upside. Doesn't seem like the upside of vol is going to be happening.
Yeah.
It's one of those, you got to be quick on the trigger finger on those, but we'll get more into that fun. You want to hear how all that broke down. Join us a little bit later this week on Options Oddities, where we break down all of our fun trades for the week. But now it is time to keep on rolling to a little bit of the old basic training.
All right, Boot, it's time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me? You're going to learn options trading inside and out, basic to complex. There will be no failures. Do you hear me? Pull in, prepare to learn.
All right, everybody. Let's get down to a little bit of basic training. This one may be a little bit more advanced, more of a 201, perhaps even a 301. I know whenever we talk time spreads, people get the willies, the heebie-jeebies. They think they're scary. And not without reason. They can be intimidating to the novice options trader. We're going to go into diagonals, going to go a step beyond calendars today. I went and looked just to check in and said, when is the last time we really talked about calendars or indeed even time spreads in a full episode on the show? It's been a while. This has been nearly 2 years just since we went full on into time spreads. That was back on episode 186, time for a time spread refresher, all the way back in May of 2022. So almost 2 years removed from that. I know we've had a legion of new listeners on the show, and a lot of you go all the way back and start at the beginning and work your way through. Others of you, you're busy. I get it. You can't make your way through all the content. So it's always good to revisit some of these topics, especially ones that are indeed timely and indeed also head scratching. We also touched on episode 185. That was calendars versus diagonals. That was May of. So we had a lot of calendars and diagonals going on in May of 2022. But that was the last time. We did a pro Q&A back in 2021. That was a bonus we actually put out to the bootcamp feed for you folks. And that one, I think we touched on a little bit of diagonals as well. 134 from May of 2021, we touched on diagonals. I think that was a listener question we responded to. And a few others, including episode 91 from 2020, June of 2020, your questions about diagonals. And then back in episode 89 of June of 2020, more questions about time spreads. So whenever we touch on time spreads, it seems to open the floodgates to questions and comments and concerns. So I guess we'll have to be prepared for that again, Mr. Dan. But this was actually kicked off, I saw in your regular email newsletter there. You did a deep dive into diagonals there as well. First off, can I say I like the new photo of you just kind of stroking your chin? It looks very professorial of you, sir. What's Dan thinking about in that photo? It makes you wonder. So that certainly made me want to click on the video there. But walk us through it. Why are you diving into diagonals now? What made it come up for you, sir?
Honestly, somebody asked me about it, and I thought to myself, I said, we haven't done a video on diagonals in a while, so let's get to it. And that's really just all it took, man. That's all it took.
You're an easy man to convince. So why do you like diagonals? What's so sexy about them for you right now, sir?
Well, like any option strategy, I like them when I like them. I like them when they fit a purpose that works for me, and not necessarily always, but a lot of the time. And there's a couple of use cases for diagonals, and I don't know if you just want me to jump into it or you want to maybe explain it to our members.
Yeah, I'll set the stage first, and then we'll get into all the use cases, time spreads versus diagonal, all that fun. Again, I know a lot of new people come into the show, even in the last few months, so we'll start. Quick refresher on time spreads. Again, if you're intimidated by these, take it easy, take it slow, go back into the archives, listen to some of the earlier shows, do some paper trades maybe in your brokerage account before you commit actual capital to these. But let's go out to everyone's favorite, XYZ. We'll start with the traditional calendar/time spread, and then we'll dial it up to 11 with the diagonal. So XYZ trading around $20 right now. You come in, you think, you know what? I think XYZ is going to hang out around this level really for the next couple of months out here. Not really going to do much. So a couple of ways you can approach that. Obviously, straight up premium harvesting is one way you could go. Or you can go the calendar spread route. In this case, you go out straight at the money calendar. That usually involves buying a longer term, traditionally at the money option, and then selling a nearer dated also traditionally at the money option. We're going to play with that in a little bit, so stay tuned. So in this case, you go out at the money is the 20 strike. So you're going to go out 2 months, buy the 20 strike call. In this case, it's going to cost you $2. And then you turn around and you sell the 1 month, also 20 strike call. In our example, it's going to get you $1 back. So now you can see, first off, what have you done? You bought that 2 month out call for a net outlay of $1. That's what it's cost you. So that's your net risk. That's your max risk on this trade, that $1 that you paid. What happens in a variety of scenarios now? Let's say XYZ closes at or below 20. Remember, we're going to key around front month expiration. That's really the key component of these time spreads. If it closes at or below $20 on expiration, your short call going to go out worthless. And now you have this long call that should have cost you $2. You have it for $1. It's up to you what you want to do at that point. Do you want to ride it? A lot of people will use the time spread as a way to get a cheaper bite at the apple for the second month. That could be your approach. You could take the whole thing off, say, okay, I'm good. A lot of different ways you can approach it. If it closes above $20 on that front month expiration, you're going to have effectively what is now a short stock position from the 20 strike, but also you got that long 20 call in your back pocket kind of offsetting it, which is why you really only have the risk of what you paid for that spread. A lot of people like to close it out going into expiration for the front month, but you could let that ride into the next month as well. Dan, what is your traditional approach to a typical straight up at the money calendar? How do you like to set them up? And then B, do you like to take them all off as a unit? Do you use the calendar as a way to get a cheaper bite at the apple for the second month? What is your approach?
Well, I mean, as far as straight at the money calendars, where I'm doing them in such a way where I'm trying to profit from time decay. So this is probably the most traditional use of calendars. Well, I mean, when I set them up, I mean, there's a couple of key, really important things that I do first. One is I'll establish that there's a channel, support and resistance, see where the estimated break evens are relative to them. I'll always make sure that there's a good term structure of volatility. And what I really love to do is I love to sell, of course, the shortest term to expiring option. And I like to buy, if there's weeklies, I like to buy a couple or few weeks out so that I do have that flexibility to roll if everything seems status quo. And that can be really very beneficial because you're taking advantage of that really super high theta and just doing it week after week. Usually you can't do these for too many weeks in a row because it ends up moving. But if you can do it for 2 or 3 weeks in a row, man, I mean, it's just a sweet little position.
A sweet little position indeed. As Dan pointed out, with all the myriad of expirations we have now, you don't need to do it the standard monthly way that we set it up. You could do it intra-week now. You could do it monthly versus front week. There's a lot of ways you could construct a calendar outside of the way we just set it up. That's just really for example purposes. All right, now let's dial it up. 201, maybe even 301. Let's go to a diagonal. So same basic setup, same basic premise, XYZ trading around $20. But this time, maybe instead of thinking XYZ is going to hang out for a couple of months, you think it might hang out for, let's say, a month. But then after that, you might think maybe there's an earnings coming up in that time frame or something along those lines. You think, you know what? I think this thing might pop out there in month number 2 or whatever the time frame is that you're setting this trade up in. You go back and you decide, okay, I'm going to instead buy now XYZ trading at 20. I'm not going to go straight at the money this time. I'm going to go a little bit out of the money, hence the term diagonal. So the diagonal spread now. You're going to turn around. You're going to buy the 2-month 25 strike. So now you're going out of the money a little bit, obviously. 2-month 25 strike call. In our example, it's going to cost you $1. So there's your first benefit. Cheaper, obviously. You're going to turn around now and then sell the exact same contract as before, the front month at the money 20 strike call. In our example, going to get $1 for that as well. So the first benefit of doing this versus the traditional calendar is pretty obvious. In the past, your net outlay, your net risk, $1. Now your net cost is $0. So that's a benefit. You're saving $1. out of the gate. That's a great thing. Some downsides, of course, to doing this. You're not long the 20 strike anymore. You're long the 25 strike 2 months out. So a little bit of a different scenario, a little bit of different risk profile for this. If it closes below $20 going into that front month expiration, same deal. That 20 strike call you sold expires worthless, and you still have this now 25 strike call in your pocket. It's up to you. You bought it for $0, so you effectively now have a free swing to the fences, a free bite at the apple. You can do whatever you want with it. Let it ride, close it out for whatever juice is left. It's up to you, but that's kind of a nice ideal scenario for that. Now XYZ closes above $20 in that front month expiration. That's where things start to get a little bit wonky, obviously, because you no longer have those truly offsetting positions. You have now effectively what will be that net short stock position above that 20 strike, plus whatever you have in that call. Now that's where it gets, again, a little bit wonky. Let's say XYZ, let's say it closes at $25. You're wrong. The stock shoots up in that front month, and now it closes at front month expiration at $25. What happens? You shorted that 20 call. It's now worth $5. So you've got effectively this call that's against you for $5. And what do you have to offset it? You don't have the same strike. You had this 1 month out of the money call. So obviously it wasn't even a 50 delta. It was a below 50 delta there. So, if it moves $5, it's not going to even make your 250. It's going to be a little bit less than that. Let's say it makes $2 in our example. So you have a call that's going to be worth some indeterminate amount of money. Maybe in our example, $3 now. Guess what? You're still out $2 on this trade. You're going to have to close that stock position out unless you want to ride a short stock position. I don't think you do. So now you're out $2 on this trade after 1 month. It's up to you what you want to do with it. If you want to let that call ride and maybe it makes back the rest of the money you lost, maybe you take your lumps and get the heck out of Dodge. But that's one of the downsides. A plus, obviously cheaper to put on, gives you a little bit of bite at the apple. Obviously, if you go the other way, it expires worthless in the front month, and then you have that call for nothing. And again, the stock can rally, and that's really kind of your ideal scenario. That's why a lot of people use these diagonals. They try to use them to get a much lower cost bite at the apple in that second expiration period, whatever it might be. In this case, it's the second month. It could be in the weeklies, however you choose to structure this. So a few more moving parts to this, a few more maybe confusing and or risky parts to this, which is why I kind of term it a 201 or indeed a 301. But Dan, you just did a deep dive into diagonals. Tell us your thought process there, why you like them. Maybe do you prefer them or not prefer them to traditional calendars? And then how do you like to set them up?
Well, I prefer them to traditional calendars when I specifically want a delta. And there's some other criteria to that statement as well. Traditionally, like the main reason why I have used them or liked them conceptually in the past is when a stock like really kind of gets hammered over a period of time. It's just like down, 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 getting beat up, beat up, beat up. And then finally there's that capitulation point where everybody just gives up and you see some pretty big down day candles that marks the bottom. Well, that's when the front expiration is really high. And that's where the stock pretty much bottoms out. And if anything is either going to trade sideways or maybe grind its way back slowly. So like that's perfect for diagonals because you get to buy these higher delta, longer term in the money calls and then sell the shorter term out of the money calls, maybe at a higher implied volatility than the volatility of the calls that you bought. When that happens, you got this like extra thing on your side. You get some edge on that trade. And it's really, really nice. So then if the stock doesn't go anywhere, you make money because you're collecting more theta than you're paying out. And if it does go up some to, but not through your short strike price, then you just roll it up and you keep doing that. Oh, one thing I left out. I always, in that specific case, I call them cheaps and deeps. In that specific case, I buy pretty long-term options. That's one of the few use cases for leaps that I have. I'll buy like maybe a year-long in the money 70 delta call and then sell the weekly call at a strike that I think the stock might be able to get to, but not through. All right. So that's use case 1. Mind if I keep going and give you use case 2, Mark?
We're all about the use cases here. We're all about diagonals. Go for it, sir.
Yeah. So another one is one that really just came up. And this is something that people were asking about in one of our classes. So if you look at a stock like NVIDIA, now there are some people who are calling for NVIDIA to hit 1,000. There's some crazy people saying they think it's going to double in a month. I don't know. It seems a little far-fetched, but let's say you're bullish there. All right. I mean, it would have been, if you can build a time machine, it's great to be bullish. But, if you're bullish now, which some people are, there's something pretty darn interesting about the setup in NVIDIA right now. Because that stock is so darn expensive, I mean, it's $90,000 to buy around 100 shares of it. A lot of traders can't afford to buy the stock, so they have to buy the options. That, coupled with the fact that, it's in the news all the time, it's making this great run, doesn't seem to want to stop. The implied volatility of the upside calls in NVIDIA, they're very big. They're higher than the at the money calls, higher than the in the money calls. So what's really nice there is you can buy like some 30-day NVIDIA in the money calls and then sell the 2-day ones or the 3-day, depending on when you look at it. You can sell the weekly calls at a higher strike, at a higher volatility. And I mean, even if it does blast through your strike price, you can still make money, but you want to give it enough room to run as well. So yeah, the fact that, just bottom line is when the upside calls in the front expiration have that volatility reverse sneer, I guess you would call it, reverse skew, where the calls have a higher volatility, the out of the money calls have a higher volatility than the in the money calls, and the front expiration has higher volatility across the board than the back expirations, you can put on a really, really beneficial from an edge standpoint diagonal if you want to play it from the bullish side. And I'm not necessarily making the case for NVIDIA being a screaming bullish trade. There's a chance we could have missed it. There's also a chance it could keep going higher. But for the folks who like that, man alive, I mean, you get a wonderful diagonal.
A wonderful diagonal indeed. And I should mention what Dan is alluding to there is something we didn't really get into in terms of the use cases for diagonals and calendars, which is a little bit more advanced even than just the trade itself. We just mostly focused on the outlook for the underlying, which is the way I think a lot of the listeners for this show will approach calendars and diagonals. But if you're listening to a show like Vol Views, we're talking about the VIX futures term structure, what Dan's talking about here with the front options actually being a little bid. There's a lot of things you could do trading term structure with time spreads as well. Buying a month and expiration that you think is cheap, selling one that is expensive, and hope that spread comes together and moves in the direction that you need it to go after all. So again, we didn't really get into that use case. That's more for, again, a little bit more advanced people out there. Just wanted to kind of refresh right now. So if you're intimidated by these, your traditional calendar spread, remember, it's usually at the money, going out longer term, buying an option, selling a nearer dated option. Again, traditionally at the money. You could do it in the weeklies, you can do it in the monthlies. And then diagonal is getting a little bit fancier out there. Now you think maybe something's going to run in the longer term. You want to give yourself a little bit of more wiggle room to capture that. Also, maybe you just want a cheaper bite at the apple. Either way, that's where the diagonal comes in. You can set them up however you like, but that's what we're talking about. So next time you hear those terms, they don't have to be so terrifying to you. They don't have to run away, hide under the covers. You can just say, okay, diagonals, calendars, time spreads. I get all that fun. Speaking of you folks, it's time to welcome you back onto the show. A little bit of the old mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, right, Dan, I was away last week down at the FIA Expo, so you've had 2 weeks to mull over a fantastic, a captivating, a, dare I say it, compelling question of the week. What you got for us, sir?
Oh, well, boy, I'll tell you what. One of the things that I have been getting asked about, well, I got asked about diagonals recently. I have been asked about short squeezes recently because there have been some interesting ones. And, people time to time ask me if those are still in favor. And I mean, they're always in favor, but sometimes they are more so than others. And this is something that I was literally just looking at before our call. And the question is, do short squeeze candidates ever have any relationship to the earnings announcements? And in the past, I would have probably said no. But I've been looking at several of these today, and it's really, really strange. Like some of these, they sell off on the earnings announcement, but then, and sometimes for apparent good reasons, like they totally miss analyst expectations by a lot. But then the very next day, the stock rockets up, and there's no other explanation for it than short squeeze. So it's something that I was just about to post something in our community chat room about that. It's something that I'm just kind of looking at right now and becoming interested in to see if maybe there's a little extra that I can add to my options trader stuff.
Yes, short squeeze is hot again. It's 2021 again, Dan, from a short squeeze and from a skew perspective in a lot of these names. Everything old is new again. Let's go out to our questions of the week, see what we had on the docket for you folks. A couple of weeks ago, we asked you, actually just last week while I was traveling, we asked you a question. Surprisingly, we've never asked you folks in the 17 years of running this network out here, which is how many options positions do you normally have open in your trading account? 1 to 5, 6 to 10, 11 to 15, or north of 15, and nearly 61% of you, 60.8% coming in the 1 to 5 camp, about almost 20%, 19.6% say 6 to 10, then nearly 15%, about 14.7% say north of 15, so those are the hardcores out there, and then 4.9% coming in at 11 to 15. Dan, does this surprise you that the lion's share of our audience keeping it in the 1 to 5 camp, which, by the way, doesn't mean they're not trading a lot throughout the week. That's just on any given day. That they could be trading, mostly 0 day, in which case they're putting on a whole bunch of new trades every day. So they're still trading a lot of darts, as the brokers would call them, just not all in one day. Dan, does this surprise you?
No, I think that sounds right. I mean, especially considering the popularity of 0 day options. I mean, if you're doing 5 of them, I mean, that's crazy. Like that's a lot. I'm wondering what you're doing. But if you're doing 1 or 2 of those and then maybe a couple others, I mean, that's perfect. I mean, you start doing a lot more trades. I wonder what your system is. I mean, the only time I'm putting on upwards of 5 trades a day, I mean, I do sometimes, but the only time I'm doing like 7, 8, 9, 10 is during earnings season when we trade total earnings domination. Like when you have a very, very specific system for very short-term trades and you can find several a day. Otherwise, I don't know. I mean, as far as trades, not necessarily investments, but trades, yeah, I think that sounds just right.
Yeah, I think that's a pretty good number too, especially for the audience of this show. Don't think because we have some hardcores out there that you have to trade 20 trades a day to be a true options trader. Get your feet wet. 1 a day is more than enough. 1 a week. Just watch it. See how it performs. Easy to get your sea legs under you. Then you can kind of go from there. Our question of the week this week, again, kind of going back to brass tacks, quite simply, what is your primary reason for trading options? Dan, we gave them 3 choices and the infamous other. Income or premium harvesting, protection or hedging, speculation or other. Dan, what would you say is your primary use case? And then B, which way do you think our audience is going?
For well, let's see. I mean, it kind of varies. I do our genius trades, the ones that are like credit spreads and wing spreads and time spreads. Those are all premium harvesting. The short squeeze ones and the total earnings domination ones are arguably speculation. I mean, they're well thought out, edge-based speculation. Protecting and hedging is something that I do, but that is not common. That's something maybe I'll put on 3 times a year tops. So I guess I would go with income/premium harvesting, and I'm going to guess that's what our people are doing too.
Look at you. Listeners? Look at you, your finger on the pulse of the audience, Dan. That's what I've always said about you at the end of the day. 55.6% of the audience right now choosing income and premium harvesting, Dan. 37.8% going the speculative route. Only 6.7% going for hedging or protection, Dan. So no put love out there. And nobody going for the infamous other right now. Everyone's diving into our main 3, which is kind of fascinating, including one of our pro members here, Mr. Age Del Aquarius. Oh, he's talking about your buddy, Mr. Don, Dan. He says, I'll echo Don Schlesinger, either sell options or don't sell them. Yes, that was Don's infamous saying, options are to be sold or not sold, never bought. And if you want to hear what the heck we're talking about, listeners, go back into the archives, the early days of our Volatility Views program when Don was my co-host out there. Fascinating stuff afoot. Speaking of fascinating stuff, Dan, we'll get out of here on this one. This is actually a listener responding to another listener, which I do love. I love to see our listeners helping each other out, Dan. As you recall, a couple of weeks ago, we were talking about stupids, and we had a listener write in, BL Hook. He said, Dan, I don't understand why you say the stupid can't be thought of as having actually 2 options at the midpoint. And he gave an example, the 12-13 call stupid. Isn't that equivalent to buying 2 12.5 calls? And we talked on that episode about, well, it's not, it seems like it from a lot of different perspectives, but it's not exactly the same thing, I should say. And we touched on a few reasons why that is. But then our listener, who is this? This is Tasty. Oh, they win for the handle, too. Tasty Mouse. I like that, Dan.
Tasty Mouse.
Tasty Mouse. He said he wrote in response to BL Hook's question. He says, hello, boot campers. I love that you did an episode on the stupid because no one talks about them. Well, you're right, except for us. We're not afraid to go there. He says, I have a suggestion for the listener, BL Hook, who wrote in to ask about trading, or I should say treating stupids as the midpoint of 2 calls. In his example, he compared buying one of the 12-13 stupids to buying 2 12.5 calls and said they both have the same P&L. In some aspects, he's correct, as we pointed out. But he's missing a big problem area. What if the stock expires at 12.5? In that case, his 2 calls would be worthless. The 2 12.5 calls that he wanted to buy would be worthless, but the stupid would still be worth 50 cents. If he's confused about why they are different, that's a pretty good way to approach it. Just doing my part to pay it forward for all the education you guys have given me over the years. Well, great comment, Tasty Mouse. Great handle. An excellent point as well. That's a great way to really clarify it for our listeners who are maybe thinking, you know what? In a lot of P&L scenarios, the 2 12.5 calls would be identical. But you know what? In that one use case, you'd be pretty darn upset that you bought those 2 rather than the stupid. So, Dan, what do you have to say here for our listener, Tasty Mouse, and his very insightful points? Helping to clarify. I love when our listeners work with each other, Dan, don't you?
I know, man. That's great. It makes it makes our job easier, right? Adding some folks to the team a little bit over here. Yeah, and thanks for writing in, Tasty Mouse. Much appreciated. And thanks, just thanks for sharing. Like Mark and I, we bring our own sort of way of explaining things that we've sort of developed over the years. But it's always nice to hear things just a little bit differently every now and then because it makes your brain think of them a little bit differently. So thank you. Much appreciated.
Much appreciated indeed. So if you too have a question, you want to have us discuss it on the show, maybe you have a response to something we talked about here on the show, or maybe even another listener. Don't be mean, though. That's the only thing we ask. But most of you, you're all awesome. I don't need to say that. Don't come slamming a listener. You're obviously not going to read that. But if you have a constructive comment or indeed a helpful suggestion like Tasty Mouse did, hit us up. Questions at theoptionsinsider.com. That works. Of course, we're at Options on most of the major social media platforms. That works as well. If you're in the Pro, you can always hit us up via the live chat. If you're in the Pro right now, hang out there. We'll be coming back in a little bit for our first ever debate in our Pro Q&A session. Carly and Russell going at it. One shall stand, one shall fall. Who shall be the victor? I guess we'll find out in a little bit. Never done this before. Kind of fun, kind of fascinating. Looking forward to seeing how this plays out. If that intrigues you, you want to ask questions outside of just Dan and myself to some of the best minds in the world of options and indeed derivatives on just about every topic you can think of. Not just this kind of stuff, but we get into futures, crypto, vol, all kinds of things on those Pro Q&As. They're led by you at the end of the day. You folks get to decide where we go, the topics, the guests, all sorts of fun, as well as options oddities. You want to hear what I ended up doing with this UVIX strangle going into the Fed, all the unusual activity we spot for the week, and a whole bunch more. Options oddities is there waiting for you. TheOptionsInsider.com/pro. The place to go to kick the tires and light the fires and see if that is for you. And Mr. Dan, if they want to find out if the old to is for them, where should they go? What should they do?
Yeah, so I'll tell you what, the best way to find out is to come and talk to me in person. Go to markettaker.com/summit and learn about our upcoming summit in Sonoma, California, wine country, which is on June 13th through 15th. And we actually have VIP tickets available right now. So go to markettaker.com/summit. If you have questions, you can just email me or message me from the website or join our chat room and DM me there. But the tickets go until April 1st, and then all the VIP tickets are done. So please go there now, and let's meet up this summer in Sonoma. And we've got some great workshops there and some great hanging out and some great things in store for you.
Wait, you told me I was the only VIP. There's going to be more VIPs than just me? Well, I'm out. I'm sorry. I'm out then.
Oh, you know, we did, Mark. We actually found somebody better. And so, we canceled your spot and brought in somebody else.
Gave it to all the listeners instead. How dare you, sir? Make the listeners VIPs instead of me. How dare you, sir? Listeners, if you want to take advantage of that offer and just slight me, markettaker.com. At the very least, you should be going to Market Taker just to sign up for that newsletter, just to see Dan's little photo on the diagonals one and all the other ones. It's worth it just for that, wouldn't you say, Dan?
Definitely. Absolutely.
Dan just stroking his chin, pontificating on all of the legion of options queries of our day. Find that markettaker.com, 2 T's. Don't forget the second T for Theta. Like we said, coming back in a little bit, not done on the network today, back with our Pro Q&A, double Pro Q&A debate. That should be awesome coming up in a little bit. Tomorrow, coming back at you with another doubleheader. First, it's the option block with our buddy, the Flowmaster, our friends over there at SIBO. After that, heading on over to CME Land, talking futures options. Who will be our guest there? You got to tune in to find out. If you like any stuff we talk about on the futures option side, that's definitely the show for you. Friday, of course, coming back. It's a Fed week. What's happening from a vol perspective? Should be fascinating. Volatility views. Who will be our guest? You got to tune in to find out. As well as, of course, coming back for the pro folks one final time. A little bit of options oddities. Pay off this UVIX strangle. Talk about all the weird, crazy trades we've been profiling this week and a whole bunch more. And then back again next Monday with the option block all the way through till next Education Wednesday. Another episode of Options Boot Camp. Stay safe out there, everybody.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.